Hello and welcome to S&P Global Ratings Fixed Income in 15, a 15-minute chat with a market voice and an S&P Ratings analyst. My name is Joe Cass, I head up market outreach in the UK. Today we have two fantastic guests on the show, Jeff Sherman, Deputy CIO at DoubleLine, and our Head of Credit Markets Research, Sudeep Kesh. Thanks for joining me today, Jeff and Sudeep.
Thanks for having me.
Let's start with some questions for you. So the intervention of central banks over the past few months has been pretty much unprecedented. As an investor, how are you reacting and adjusting your portfolios to their actions?
Yeah, I mean, it has been unprecedented to say the least, not just from the central bank standpoint, but also the fiscal wherewithal of the developed world to really deploy capital to ease the liquidity crunch we saw. The problem with it is that there was no liquidity in the month of March. It was one of the worst markets we've ever seen. Even our senior folks that have been in the markets 30 years have never seen a market trade as poorly as it did or just did not trade. You had bid-offer spreads on off-the-run treasuries trading points wide. So, yeah, they have premium prices, but still, a 1% bid offer on the most, supposedly the most liquid part of the markets in the world is just unprecedented as well. So there was some need to step in. We can question the moral hazard risk that's been created by what the central banks have done. I think that the lead has been with the ECB by buying corporate bonds. It's kind of opened the kimono here in the U.S. For them to do so as well. And so the mantra was don't fight the Fed. It's always been that way. But the problem at this point now is there true price discovery? And so what we've seen is that parts of the market where the Fed has not intervened or has not provided that type of support have lagged significantly. They still trade at some dislocated prices. So that's the things that I would argue that investors should look at because that's a true price discovery market. The stuff that the Fed has been buying directly, that's agency mortgages, agency CMBS, and obviously treasuries, those rallied fast, hard, as we've seen in rates. But then also this extension of these liquidity facilities to pop up parts of the credit markets have, I think, distorted prices. And so we had a record-breaking event last week where the yield to worst on the IG index, like the Barclays credit index, traded inside of 2%. So to me, is that a really good price of risk today? Yes, people look at it from a spread perspective, but we can find high-quality assets in other parts of the market where the Fed's not supporting that generate still what we think are 3 to 5% type of yield potential today. So looking at that, that's the way we're positioned is, the Fed train has kind of run its course. It's distorted prices, and so we just don't think there's a lot of value in chasing those assets.
Yeah, sure. So the BIS defined zombie companies as firms that are unable to cover debt servicing costs from current profits over an extended period. So we've written a lot about these so-called zombie companies at S&P over the year. Sudeep actually in particular has published some fantastic research reports on this. So what's your take, Jeff, on the future for these firms and how are you kind of expecting the situation to play out?
Well, I think, as I said, we come back to moral hazard again because, it's not letting the free flow of capital do its job, right? Capitalism, you're supposed to be a risk taker, and if a company can't survive, it's supposed to go out of business, restructure, or redefine itself to be able to support itself. So what you've seen here is that this liquidity I talked about is providing just that. It's liquidity. It's allowing people to fight another day, but liquidity is not a cure for solvency. Right? If you don't have a good business model, which a zombie company by definition doesn't, it's got too much debt, it's too levered, then it shouldn't be in business. And so I think the work you guys do is great on this type of stuff. I think it's very important. But at this point, it's almost like no one wants any company to fail. And we know that that stifles innovation. It stifles, the good use of capital as well. So I think what you need to really focus on is that, okay, when the dust settles, how is this going to shake out? And so we've seen this too, where for instance, the Fed picks winners and losers, in the marketplace, and that's what I'm talking about in the credit markets today. That they've chosen that they're going to back the corporate market. And even when Mr. Powell went to congressional testimony and they asked, "Why are you buying, corporate bonds at this stage?" The market seems to be functioning well. He said, "Because we told you we would." And so I think what they're trying to do is deliver on the credibility side. but is it really credible to lend money to companies that really can't survive? And that's the biggest challenge I see out there.
Thanks, Jeff. Sudeep, over to you. I know you and some of your team have published, well, numerous reports on rating actions related to the coronavirus pandemic. I saw a nice piece looking back at the ratings environment before the current crisis. Can you briefly tell us about that piece and maybe how the situation might progress from your perspective?
Sure. Yeah. That's it goes really back to what Jeff was just talking about, actually. So the thing is, going out of the great financial crisis, you had this perpetual low interest rate environment, which in many senses encouraged a lot of risk taking because you had few low risk alternatives. So companies, a lot of non-financial companies were basically taking these higher, more aggressive, risk policies and so on, and subsequently those would carry lower ratings. So we ended up starting this crisis. I think in the U.S. it was about a third of all companies were rated in the single B or lower categories, which is extremely risky. And what you see in downturns is that these riskier areas of the credit market end up experiencing downgrades more frequently, and at the very low end, what we call weakest links. These are single B minus companies with either a negative outlook or a credit watch negative. These carry a huge amount of default risk. So the thing is that coming into this crisis, because of all that risk taking, we were basically in a much more vulnerable position. And we had a piece called, or a series called When the Cycle Turns. We were worried about this for some time. We weren't the only ones. A lot of investment houses were basically publishing about like when that shoe drops, what's that going to look like? Admittedly, I don't think anyone thought it would be a pandemic that would sort of break the camel's back, if you will. But that was kind of where we were before the crisis. Once the crisis hit, it was we acknowledged that this was going to be really, really bad, a very, very sharp downturn, and for a sustained period. That's when things in March, capital markets really kind of came apart. There was indiscriminate selling, all these other kinds of things, and we had tons of downgrades really as a result of entering with a weaker profile, having those all of that negative news basically all come at once, and then you saw this swath of downgrades. So since then, things they've improved in the sense that the pace of the downward trajectory has slowed considerably. I think last week we downgraded we took 22 negative rating actions. The majority of them were downgrades, also on spec grade companies. But that's about 1/14 of what you've seen in March, for example. So the thing is, things are slow, but they're still quite bad. They're still quite vulnerable, and that's one of those things that we're watching out for.
Sure. So investors, they're always very, very interested in the fallen angel aspect of credit ratings. Yep. So downgrades from investment grade to high yield. So are there any insights you can provide on fallen angel trends over the period of the crisis?
Sure. So right now, through the end of June, there were 34 fallen angels. Just as context, I'm not sure that everybody's aware of this. Fallen angels actually make up a fairly small part of the investment grade market. So typically they're about 1% or so. Now we're about double that, and the reason is because of this compounding effect on COVID-19 and its sort of dry up in travel. So you've seen a number of fallen angels as a result of airline downgrades, which took a direct revenue hit, and it was compounded with oil price. Everything that was going on between Saudi Arabia and Russia. So the thing is that oil companies that they were investment grade, so they were well capitalized and everything. But the thing is, now you see this huge decline and sudden decline in revenues and so on. So you saw a lot of oil companies become fallen angels, as well as midstream. So I think the theme there is really things that really took a direct hit to COVID-19 and the oil prices. Things that were sort of more market, in terms of like dislocation because of market, I think are higher investment grade names, like in the single A's, the triple B's and things like that, were largely okay in the sense that they still had sort of funding sources and things like that. Again, at the single B and lower, that's where the biggest risk was, but that's a significant part of the rated portfolio.
Jeff, you've worked very closely with Jeff Gundlach, CEO and founder of DoubleLine, and the man who's taken over the mantle from Bill Gross as the Bond King. What impressive qualities does he have, personal or professional, that you maybe try to replicate? And have you got any interesting story or example of that?
Well, I think one thing that he does very well is that he definitely has a way of looking things a bit differently, and so it's being open to commentary, and he's really good at bringing the best out in people. So I would say that one thing that's a good attribute that he possesses that we'd all like to have is motivating folks and getting people to bring you analysis. Right, that's the backbone of the investment side. Is you want to have new ideas. And that is something that I think he promotes very well, that we have a lot of free forums where we sit and discuss. Sometimes we have meetings where they're just completely off of financial topics, but they're interesting things. So a health pandemic or just things that we think will lead itself into investing. And so we may spend an hour or two in a given week talking about politics and what does it mean, what's the development. And so I think the key attribute is making sure that people's voices are heard, and no idea is a bad idea, right? The whole thing is it's supposed to be a forum to learn from, and that's something that I would like to take away. Try to be a better leader, and make sure you can motivate your employees to bring stuff there, give them a comfortable work environment, and even in this work remote, we've had massive contact with our investment team, and I think that's the backbone of these investment houses is that you need to have people working together. We all got to move in the same direction, and you need good leadership to do that.
I mean, on that point, Jeff, I know you're a big fan of baseball. It's not huge this side of the pond in the UK. Yep. So for the uninitiated of us, can you tell us a bit more about sabermetrics and its role in baseball?
Yeah, well, sabermetrics was named after a gentleman. I'm forgetting his first name, but his last name was Saber. And what they were doing was pulling it all together to quantify some of the metrics in baseball. And so what it really happened, and this was a big push, and I think Michael Lewis wrote the book Moneyball about the Oakland Athletics, and what it was just bringing data into the game. And what was the revolutionary part of it is there was so much conventional wisdom in baseball, these stories that people tell, this is why you do it, but if you went to the data set, it was completely false. So it's this idea the narrative was driving behavior. And when people started to look at more scientific data behind it, what they found is there's better ways to execute game plans. And so probably on that side of the pond, and a lot of folks probably in the U.S. think baseball is a very boring game. It's very slow moving. I think cricket's the same way, by the way, especially as someone who doesn't really understand it. I've watched it many times traveling and still can't get my head completely around it. I kind of know when it goes over the fence and stuff, but at the end of it, I think what you find is that they made the game, the planning of the game, much more calculated, and it is a very, very challenging game. Whoever decided that you're going to use a cylindrical object to try to hit a spherical object, I mean, just the physics behind that is very challenging to start with. And I think one thing that I've always been amazed with in baseball is that you're a superstar if you fail 2 out of 3 times. So a batting average of like 3.33, 1 out of 3. If you get a hit 1 out of 3 every at bats, you're a top tier player. You're going to make 10, 15, 20, $30 million a year nowadays. But you failed more than you succeeded. Can you imagine a footballer, doing that, or a basketball player shooting 30%? You're not going to be able to continue to play. So it's one of those games that the difference is it's pretty amazing because a mediocre player maybe hits 250, which is 1 out of 4. But that 33% is a superstar. So there's just nuances of the game. It's a very, very calculated game. And when I played, I was a catcher who kind of runs the field, and there's a lot behind that. And so I've always just appreciated that. So when I watch baseball, I like it from the catcher's perspective. I can't stand to sit in the stands. I'm way out there. I need to see it. I want to watch every pitch and look at it. So.
Yeah, there's a book I'm actually reading at the moment called Soccernomics. And it's essentially exactly what you're saying, but for football, for soccer. And there's a couple of instances where smaller clubs have kind of picked off individuals just on the data who were sort of 5 or 6 divisions below, and then ended up buying them for, say, like £1 million, and then selling them for kind of 35 or 50 million after a couple of years later. So it's kind of coming to football, and arguably it's on its way, but I think obviously baseball seemed to have been as leading the way.
Yeah, no, it definitely started there. Now, I will say that I'm not a big fan of like launch angle and, bat speed and how the ball came out. That doesn't interest me as much as just going back into that raw data that you're talking about, Joe. And that raw data, is really how Billy Beane created. He kind of launched this program with the Oakland Athletics in I think it was the early 90s, and that really took off. And that was the premise of Michael Lewis's book, which they also turned into a movie. I guess it doesn't hurt to have Brad Pitt play the lead character. That tends to make it a popular movie as well. So
yeah, always helps. Okay, Jeff, one last question for you before we wrap up. So on top of the DoubleLine Deputy CIO gig you also have your own podcast, The Sherman Show, where you interview DoubleLine executives, other investors, academics. So you've actually recorded 75 episodes. Pretty impressive to date.
Wow, I didn't even know it was that many. That's impressive. I'm shocked by that. I think 20 of them have been during the pandemic.
It's substantial when you look back at it, I suppose. Yeah. So which guests have really stood out for you? And should I have any of them on Fixed Income in 15?
Oh, well, my number one fan, and this is me being a bond nerd, and I think probably Sudeep would agree with me, is Jim Grant. I mean, Jim Grant, he writes Grant Illustrated Observer. He's a wonky guy. He is so brilliant. You need a dictionary to talk to him. He pulls out. I mean, he's just a great writer. He writes deep. He understands the Fed. He understands the bond market just inside and out. He's a recommended, a read for anybody out there. First of all, he has this witty, dry sense of humor. Very, very dry. And that was my favorite guest, hands down. No disrespect to all the other ones, but that's kind of like a hero of mine too. So from that perspective, I think you can learn a lot from Jim. He's been doing it for roughly 50 years now, and he's just got a great background and everything. So for a fixed income guru, I think 15 minutes with him is probably worth like 6 hours with some other folks.
Yeah, sounds good. Well, listen, we're
gonna break out your bow tie though.
A bow tie, yeah. He definitely rocks the bow tie. He does it well, and like I said, you're going to walk away just with more knowledge. You may have a lot of questions about what he said because this vocabulary is just so expansive. But definitely, he has his own unique flair, and was definitely my favorite guest. Not sure if all my listeners thought the same thing, but I think that was just me being a little bit of a fanboy.
Cool. Well, I mean, we're coming up to time, so. Sudeep, Jeff, thanks so much for your time today. Thanks for listening, thanks for watching, and see you next time on Fixed Income in 15.